Hello and welcome to this week's edition of Econoday Unplugged. It's Tuesday, the 9th of June 2020. Mark Pender is stateside and I'm Jeremy Hawkins here in London. Oil prices remain volatile and a bounce at the end of last week was primarily triggered by news of an extra month of output cuts from the OPEC Plus group. However, more generally, their recovery from April's lows reflects hopes that global economy will soon be on the mend. And with that, crucially, will come a pickup in demand. If you're looking for a V-shaped recovery, well, there's already been one in the tech-heavy Nasdaq, which hit a new all-time high last Friday and is still on the way up as we record today. Further signs of a risk-on mood can also be seen in the currency markets, where the dollar index has now fallen for 3 consecutive weeks. But it's not all a one-way flow, and some Latin American currencies are struggling as COVID-19 numbers rise, particularly in the likes of Brazil and Mexico. Of course, a major boost to sentiment has come from the US May employment report, where the consensus on non-farm payrolls is too weak by a mere 10 million or so. And that's probably the best place to start. So, Mark, employment up 2.5 million on the month, just ahead of the FOMC meeting. Go on, what's going on?
I don't know what's going on. It doesn't all add up. What's interesting, besides the size of the enormous miss, the Econoday consensus for that was minus 7.7 million jobs, and it came in at plus 2.5. So that's over a 10 million size miss. What's interesting is the month before that, it was almost exactly on the consensus at minus 20.5 million as the final result. But it was a complete shock, and it doesn't correlate at all with jobless claims, which have been coming in about 2 million a week. And so it had the forecast sample wasn't even close. The most least pessimistic forecaster had it at 3.5 million loss. So even on that, that's a 6 million or so miss. It's pretty inexplicable. And we'll have to see, of course, if it's repeated again in the next report. We just had, but there was something interesting. Today's Tuesday, we had the JOLTS report out, and this is a lagging report produced by the Labor Department for April. What's interesting is it showed a sharp decline in job openings, as you would expect, but also in April, a sharp decline in hires at the same time. So the difference between the two was still very large in favor of openings by about 1.5 million. And so that's a very strong sign, or a positive sign for labor, that these openings were, I guess, getting filled. So it's kind of a blurry mess right now. And we have also, go ahead.
Can I ask you, in terms of because the employment situation is put together off 2 surveys, isn't it? Establishment
Yes.
one and the house. What did the household survey say about employment?
It was also very likewise favorable. That's the one that includes the self-employed people who are contractors who are not on payrolls, and that's where they calculate the unemployment rate from, because that's the greater size, about 160 million that comes out to. And the unemployment rate there, it was supposed to approach 20%. 19.8% was the consensus for us, and it came in at 13.3. So, and that was down from 14.7 in April, but there's a lot of loose parts going on. The Labor Department has been I wouldn't say fudging it, but they're splitting hairs between people who say they're unemployed temporarily. They think they're going to get their jobs back, but they're not working. And then there's others who are just unemployed and don't expect to get their jobs back. So this is a kind of a special category that the household survey takers. Now, so the household survey is unlike the payrolls, which is done from payroll data like ADP and those kinds of things. The household survey is individuals, and so this is a body of survey takers, and they were saying that there has been miscalculations the last couple of months, and on how to categorize people who aren't sure whether they're going to get their jobs back or not. But if you just take this category as being simply unemployed, then the unemployment rate goes up about 3 percentage points. So that would be about 16%. And last month or April, the report would have been about 20%. So they're splitting hairs there a little bit. And it's a very messy report at a very critical time, by the way, for economics and history and everything. And for them to be fudging it like this and making it blurry at this moment isn't going to sit well, as far as the reputation of the Bureau of Labor Statistics.
I mean, you're really just better off taking the last couple of months together and dividing it by 2.
Yes, and actually probably the next month divided by 3. So. Yeah, but what other indications do we have in the labor market? We're talking about the payrolls. ADP didn't see this. ADP has a huge base of payroll data that they use, but they also, because of their lack of accuracy or predictability, it's a bit on and off the ADP. It doesn't correlate entirely well. So what they do is they go in the past and they include different factors in there and try to come up with a better score. And what they do is they use the unemployment claim. So as part of their calculation. So they were picking up a weakness, not strength at all. So it was completely out of the blue, so we'll see how it goes. Now, of course, that raises the question: are we already on the recovery? And it would seem pretty hard to believe that we're already on the recovery. I mean, we just had Redbook retail sales today, and they were down about 10% on the week. And of course, this is the week of the George Floyd looting, store closing, so that may have had a factor there. But in any case, I really don't see this huge upsurge happening right now in the economy outside this employment report.
So FOMC this week, dovish?
Oh, yes. There's not going to be maybe Jerome Powell's characterization of will be less dire of what the outlook is. And I guess that probably has been the trend here with Powell's commentary starting, I think, about April. It was pretty grim, and it's been less grim. And but in any case, for policy, they were already at maximum, unlimited QE. They've already said they're not going to go. Jerome Powell has ruled out that they're going to go to negative rates. So all they can really do at the meeting is, loan programs, maybe bank regulations, those kinds of things. They're kind of out of it. But let me ask you about.
Just before we end on the policy side, a quick question. There's been some talk looking across what's been going on in Japan. That the Fed, as you say, they don't want to go negative, but they might possibly consider some kind of yield curve control, given the backup we've seen at the longer end of the market. Is that feasible, or is that something not really worth considering at the moment?
No, I think that is feasible. That might be a question to ask. Certainly, they're buying in all different maturities, on the QE. So it used to be that they would, confine their direct buying, but now it's a completely open field. So they might try to. In the past, they wouldn't, they would say policy. It wasn't. They couldn't really control long rates. It was only the short rates they could control. Mm-hmm. Well, maybe they will expand out to the long rates. But let me ask you about the ECB now. Last week so explain to us their QE program and how it's broken out and how that relates with the German ruling.
Okay, so let's start with the various aspects of quantitative easing as far as the ECB is concerned at the moment. So their main asset purchase program, which is probably the one that most people are most used to in terms of what actually QE stands for, that was left unchanged. So effective, that means that they will continue to buy 20 billion euros of net asset purchases every month, and it's been like that for a little while now. At the previous meeting, they also announced what they call a temporary envelope of additional QE which was worth 120 billion. Flexible purchases sometime between, well, effectively when they first introduced it and the end of the year. So it could vary between different months, whatever it may be, but over the course of a year, that would be worth 120 billion. The ECB last week didn't make any changes to those programs. What it did do, though, was to expand its so-called Pandemic Emergency Purchase Program, which it launched back on the 18th of March. Now, market focus had been that if there were going to be a change in QE, and generally speaking, speculation was that there would be, then it would be expanded by perhaps up to 500 billion from the current 750 billion. As it turned out, they expanded it by more than that, by 600 billion, which means it now stands at fully 1.35 trillion. So that was comfortably above the upper end of market expectations. In addition to which, they've actually extended the horizon for these purchases, which will now run until at least the end of next year. Now, it's important, as I think as we touched on last week, simply because the political background to this. We had this German High Court ruling, which effectively rules most of the ECB's QE as being unlawful under German's constitution. So there's a big battle at the moment between the ECB and this German court involving the European Court of Justice as to basically whether or not the ECB can continue to do what it's doing at the moment. However, this German ruling did not include anything to do with directly compensating for COVID-19 effects, which meant effectively if the ECB wanted to expand QE, it could do it through this Pandemic Emergency Purchase Program, the so-called PEP, which is what it opted to do. So I think, normally I must say I'm not overly impressed with the way the ECB responds, because it tends to be very much reaction rather than being proactive. But this time around, they've come out, they send a clear message that, look, we want to increase QE. They don't want to stir the political pot by all means, but by doing it through the PEP, by doing more than the market anticipated, it was taken extremely well, particularly by those peripheral Eurozone markets like Italy and Spain and Greece, which generally speaking suffer more when we have the big downturns and really need the extra help. And the more money will be allocated in their direction. And also just by doing anything at all, it's helped to underline the ECB's attitude. Look, we're an independent central bank and we're going to do what we think is right. And it's quite often been the case in the past that the ECB's made an announcement and the market reacts as being, well, is that it? Well, in this case, it was very well received by the Eurozone, by the Euro, I should say, because it was taken as being providing potentially a decent boost for the Eurozone economy. It was taken extremely well by these peripheral markets because it's going to boost the buying of the likes of the BTPs and so on. So all in all, it was a good result and pat on the back, I think, as far as the ECB is concerned.
Do you think it's a policy offset to the lack of fiscal help on these peripheries?
Yeah, I think that's a very, very fair point. I think the ECB sometimes must be scratching its head. For so long, going back to the days of Draghi, the number of times at the press conference, the president would come out and say, of course, what we're doing now has to be work hand in hand with a more expansionary fiscal policy. And for those governments, bottom line Germany, which have room for fiscal reflation, they should really be going out and giving the economy a helping hand. And I think we're in the same kind of boat now. Yes, we've got this new next EU generation fund, which the EU Commission is trying to get through the parliaments at the moment, but that's going to take time. It's still got resistance from some members, and the ECB must be taking a view, well, look, if nobody else is going to do it, we're going to have to throw whatever we can at it. And indeed, I think from the tone of the press conference itself and the minutes of the meeting, well, the official statement, I should say, the inference there was, well, look, we're doing all this, and if it's not enough, we'll probably do more.
Do you see, to change the subject now, any sign, and get back to the employment report, do you see any signs of a V shape coming out of European data?
No, not really. I think clearly, we're only just starting to get through the hard April data, and all you can say about that at the moment is going to be blooming horrible. We just had German industrial production for April. That was down 17.9%. Surprise, surprise, a record on a month-on-month basis. It's down 25.3% year on year. Now they are horrible numbers, but fair enough. You might think, well, the lockdown started to be eased to some extent as we move towards the end of April and into May. So the May numbers might look a lot better. However, even though we had output down, with industrial production down just over 25%, orders fell even more. And year on year, orders are now down, getting on for 40% or so. So currently, as quickly as production is being pared back, pent up demand already in the pipeline is falling even faster. And it's the same kind of thing we're seeing coming out pretty well right across the Eurozone at the moment. So I think in terms of the V-shaped recovery, it's hard, I think, certainly for Europe to find anyone who's looking down that road. Expectations are that, yes, output has fallen so far that as we do get more and more relaxations of the restrictions coming through, the shops are opening, people will be allowed to go out and shop that much more, factories are gradually starting to reopen, we will necessarily start to see output and demand go up. But it'll be going up from such an unprecedentedly low level that the idea of a V-shaped recovery to get back to where we were before COVID-19 struck, well, it really seems to be pie in the sky to me.
Are there any anecdotal weekly reports, news reports, man in the street reports on how the reopenings are affecting retail in Europe?
Not much so far. We had some one of these sort of surveys from the UK this morning, which suggests that retail sales were still falling as far as May is concerned, but certainly not as quickly as April, which you would kind of expect. And there's been various stories coming out of individual sellers suggesting that May across much of Europe, particularly in Germany, will be a good deal better than it was in April. But again, we've still got social distancing and all these various constraints on how consumers can operate at the moment, and that will necessarily restrict just how quickly, even if they want to go out and spend, how much they can actually do any particular time. And in general, from the surveys I've seen within Europe, and particularly true of the UK, there is still a very much a real concern about safety aspects, about how safe it is to go out and try and resume a normal life, given the fact that for a lot of European countries, as good as the COVID-19 numbers may be at the moment, there are still new cases being recorded. And as long as that's the case, of course, if you're a shopper, a consumer, there's still the risk you could actually contract something.
Well, I guess we're all still subject to these virus readings, and if they do pick up back up, then the V shape might just go out the window. However, if they do remain low, and if the social distancing does work, and we're able to produce goods and services and buy goods and services, still though, you would think it would take quite a long time for the economy to heal here. So.
Definitely. In fact, it's interesting talking about that. I saw a survey come out of Switzerland earlier on today, looking at productivity rates as a result of COVID-19. I've got to be honest, I can't remember the precise number on the top of my head, but essentially productivity rates in Switzerland since COVID-19 struck being gone up around about 16% or so, something like that, which means that workers effectively are working more efficiently now, working from home and everything else, than they were previously. And that kind of, I think is going to set the scene for how the world economy works as we go forward. There will be more people working at home, less time will be spent trying to travel from home to your place of work, where of course that's possible. And we will see a completely different structure. And another interesting thing I saw looking at Europe, which is one of the issues that I think the European Commission will be partly trying to address in this new fund it's bringing out. And that was just, 17% of businesses in Europe, which is in the European Union, with less than 250 employees selling online. Sorry, only about 17% of businesses, I should say, with less than 250 employees in the European Union are actually working online. So there's this huge market, which at the moment, Europe really isn't tapping into. We're kind of a long way behind, the digitalization of the service side, the retail side, compared to perhaps the likes. I don't know the equivalent numbers in the States, but I suspect it'd be a good deal higher.
Yeah, I guess about e-commerce, it represents about 10%. If I remember the numbers right, it's been going up, but I think it's maybe about 10% of total retail sales, if not a little bit more. What's it in Europe, you think? Do they have that number?
Off the top of my head, I don't know. I know certainly in terms of UK retail sales, it's been running around about 20% or so, something like that.
20%. Wow.
Yeah. It's been gradually creeping up, and the COVID side has actually picked up quite significantly. But I think UK is quite well ahead of most of Europe.
Yeah, this data I'm talking about in the U.S. is a quarterly, so we haven't seen what the COVID effect would be. But we do see non-store sales in the retail sales report, and that is mostly e-commerce, and that has shot higher. So, you know.
Right. In terms of COVID, I suppose I should quickly mention good old Brexit, since really, I guess, the potential impact on the UK economy, and indeed the European, the EU economy as well, of a no-deal Brexit is that much potentially more significant now, simply because we have the coronavirus bringing about the damage of its own. So in terms of these talks, the fourth round of talks this year got underway last week and finished last Friday, and to all intents and purposes made no progress at all. And the worry, I think, for markets, and I say it's worthwhile remembering that Brexit is still lurking in the background, is that the UK has until the end of this month to request an extension of this transition period that we're in at the moment, which runs until the end of this year. If they don't ask for it by the end of this month, and Boris Johnson is saying he's not interested in extension, he's not going to do it. So in effect, it just leaves the best part of 6 months or so, and probably less than that, because it's going to have to be ratified by European parliaments, to actually get some kind of trade deal thrashed out between the UK and the EU, or the UK, which has already left the EU but is still trading as if it hadn't, come the beginning of next year, it will be completely on its own. And no trade deal is going to mean higher prices with UK, higher prices for the rest, for the European Union as well, because we'll revert to some kind of World Trade Organization tariffs. So I mean, it's going to be, could well be, as we saw for so much of the last couple of years, performance of the pound and the gilt market, UK stock market, was simply tied to, are we going to get Brexit? Will it be a hard Brexit or a soft Brexit? All this stuff about, well, at least a hard Brexit and a soft Brexit, that's going to start coming back again, particularly over the second half of this year. So expect sterling to become increasingly volatile.
Was Brexit an issue for the ECB last week? Did it pop up anywhere?
Not as far as I know. I must say, listening to Lagarde's press conference, I didn't actually hear her mention it. But certainly, I mean, prior to, Brexit actually taking place, Brexit was a regular comment in terms of the downside risk to the Eurozone economy at all the ECB meetings. And I suspect we'll start to see it being cropping up in the conversation and the minutes as we go through the rest of 2020.
Now, how are the travel quarantines? The UK has one, right?
Well, it's a bit in the air at the moment. In theory, UK quarantines came in at the beginning of this week, or at least on Monday, which meant anyone effectively flying in or travelling into the UK would have to quarantine for 2 weeks. However, there's been a huge backlash against it, particularly by all the airports and the airlines, which are essentially saying, well, look, if you do that, then the UK tourist industry is completely down the pan, because someone's coming over for a 2-week holiday, they're not going to want to spend it quarantining and just to get on the plane to go back home again. So it looks as if that's going to be changed.
What about the UK going out to the Mediterranean for holiday?
Well, that's mixed at the moment. I mean, in some cases, some of these southern Med countries have opened up to parts of Europe, but not the UK, because the UK COVID numbers have been higher than the likes you've seen in Germany and those other countries where the numbers have come down more rapidly. But again, it's still the case, if you're a UK traveller, let's say you want to go out to Athens for a holiday for a couple of weeks, when you come back, you're going to have to self-quarantine for 2 weeks again. So a holiday which perhaps you've got 2 weeks is suddenly going to have to be 4 weeks. So it's difficult at the moment. I can see what the government's trying to do is trying to stop, the re-importation of new coronavirus cases. But at the same time, it's the risk is it's going to crucify a big swathe of UK industry.
Well, so accommodation and leisure and
exactly that. Yeah. So it's difficult times, but that's true of everyone at the moment. Okay. Is there anything else we should be mentioning?
No, we talked about Brexit, so that must be the end.
That's got it. Yeah, Brexit. Yes, take the BR off the front of it. Okay then. Well said. Let's call it a day for today then. We'll be back next week, but in the meantime, remember you can keep up to date with all the key data and events in Econoday's global economic calendar. So from Mark and myself, thanks as always for listening. Stay safe, and we'll see you next time. Bye for now.